All right, everybody, welcome to our lunch hour session. I hope everybody is maybe listening to this at their place or wherever you're at and have been able to get a snack or some food. And if not this session with Dave, then maybe it'll be the next one. But welcome back to LSW 20. This is a session I've been personally looking forward to, raising investment in a recession with Dave Harris. Dave's with Rocky's Venture Club. He's the director of operations there. You facilitated and led hundreds of many rounds, and is a very qualified expert on how to do this stuff, especially in this current moment. And Rocky's Venture Club is Colorado's oldest, I believe, and long-standing angel investment network. So he has a lot of access to the people who are making these decisions anyway. So I'm so excited for this session. And I'm just going to turn it over to you and have some fun.
Cool. Well, thanks, Morgan. Appreciate it. And thanks again to you and the Longmont Economic Development Partnership for putting on this week. Hope everybody's having a great Longmont startup week and hope everybody's staying well. So, as Morgan shared, I'm Dave Harris with Rocky's Venture Club. I'm also a managing partner with the Rocky's Venture Fund, which operates alongside our group. And then I'm also managing director of a new fund, which we just announced last week, called the Pandemic Impact Fund. And so just so you have some context about the vantage point that this session is coming from, just want to tell you a little bit more about, what we're doing, so you kind of know, where we're coming from. So as Morgan mentioned, we're an angel investor group, longest running group actually in the country. Been around since 1985, and we're made up of about 200 investors. So all of us collaborate to look at investment opportunities, conduct due diligence, ultimately invest, and then support companies after we invest. Our fund, the Rocky's Venture Fund, has been running since 2017. We've made about 35 investments out of that fund, and it looks at a lot of the same deals, but operates independent of the group. And then the Pandemic Impact Fund, which we are working on now, will be raising up to $100 million. So it's going to be investing a little bit later, but in about 25 to 30 companies across its portfolio. So, as Morgan noted, I've led and facilitated about 150 investments in my time with RBC and with our first fund. So what I'm sharing today, it really reflects certainly personal experience that I'm observing in this current downturn period, but also experience from the last one, along with what I'm hearing from co-investors really around the country, because we work with syndication partners all over the US to share deals and often bring in a lot of out-of-state capital into Colorado. So that's where we're coming from. Before we move on, I just want to say, for the session today, feel free to jot comments, questions down in the chat. And then I'll keep an eye on it. Morgan will keep an eye on it. As we're going through, if you have questions, I'll be sure to address those. And then we'll also have some time at the end for Q&A. All right, so let's dive into this. Our topic today, raising capital amid a downturn. And more poignantly, raising capital in 2020. It goes without saying, it's an unprecedented year, and the ripple effects of the COVID pandemic are going to be felt for years. So how you navigate a raise in this climate when there's such economic uncertainty and we're in such unprecedented times. Now, for the sake of today's session, I'm going to make some assumptions. I'm going to assume that if you're here, that you're watching because you're either one, considering a fundraise in the near term, two, you're already in the middle of a raise now, and maybe the pandemic threw that off a little bit. Or maybe three, you're fortunate enough to have already raised some capital prior to the pandemic, but maybe you're thinking about your runway, you're concerned about it, so you're maybe considering sort of a follow-on raise in the near term. On top of that, I'm going to assume that the folks in today's session are either in the sort of pre-seed, seed, or Series A stage, and I'll give those some definition a little bit later. And so with those assumptions in place, how do we determine to best position our raise in 2020? That's really what we're after today. So a good place to start is by reading the past and really look at how fundraising was affected by other recent recession periods. Now, no two downturns are exactly alike, but there are some unifying dynamics that we can pull from the last few. So let's just hop in our time machine to 2008. And late 2017, this really started, but really 2008, or I'm sorry, late 2007, it really started, but 2008 was really kind of the catalyst year. And of course, very different catalyst that year. It was more, tied to real estate and financial markets, whereas we're talking about a public health crisis now. But again, there's a lot we can learn from that period. So the Kaufman Foundation put out some really valuable data about how the startup investment markets were impacted by the 2008 downturn. And what they found was that really across all round types, from pre-seed, which really is raising your first like $10,000 to about 250,000, to seed, which is about 250,000 to 2 million, to Series A, which is usually, at least in Colorado, 3 million or more, all the way down the alphabet. So B, C, Series D, across all of those periods, round sizes decreased. So not a huge surprise there. The medium round size went down as capital became a little bit more difficult to get a hold of. Across the board, founders were raising lower amounts, and in some cases about 30% less than pre-2008 round sizes. Now, it's unlikely that startups just decided overnight to become more capital efficient. So this was clearly driven by the market itself. So this is a big takeaway. This is probably something that we should expect in 2020 and in 2021. Another thing that their data showed was from really 2009 all the way through 2012, those ripple effects were felt. And so not only were companies raising less capital than prior to the 2008 crash, but they were also selling a higher percentage of their company in exchange for that capital. So, they were being diluted more heavily as capital was harder to come by. And in turn, valuations were impacted. So 2009 in particular saw the median valuation for a seed round and a Series A round. The median was almost cut in half from where it was a year prior. So in summary, looking at this 2008 catalyst year, startups underwent longer periods between funding rounds. They had to stretch more of their dollars out. They saw considerably lower valuation increases between rounds. And in addition, there was a lower propensity of raising follow-on capital. So those are all things we need to be considering in 2020. And as we think about this year, should we expect similar market response? I'll talk specifically about valuations a little bit later, but let's discuss first capital availability, because that's really important when we're talking about going to raise capital this year. And in addition to availability, what's the expected behavior from investors today as you're exploring a raise later this year? So first thing, let's start with just getting a read on our target market of investors. And for the founders on the call, this is just like when you're bringing your product or your solution to market. Okay, you have to segment and then study your target customers. You have to figure out how they operate, where they live, what they truly need, and what they're looking for as consumers, and then get out of the building and talk to them, and then you iterate. It's the same thing with fundraising. When you're going to raise capital, you're taking a product to market. In this case, the product is equity in your company, which you're going to sell in exchange for capital so you can grow. Now, keeping that in mind is really key, but let's get an understanding of our target market first, and just how they're behaving. The first thing, are folks investing right now? Is new capital actually being deployed, and are investors in the market for new investments? So to answer this question, let's just look back at the last few months. So going back to specifically mid and late March. And as we all know, what happened was we all rapidly shifted to virtual working environments. And investors did just the same. So those of us that had been deploying capital for a number of years, we really shifted to looking at new investments, to just prioritizing our portfolio companies. So just the companies that had already received investment from us, that's where we really had to put some priority. And so we took a couple week pause on reviewing new deals, and really focused on our portfolio companies to help them to navigate, for instance, some of the CARES Act SBA loan programs like the PPP and the economic disaster loans, or in some cases supplying bridge round investments. In some cases, providing guidance when they had to make some really difficult decisions, like to lay off employees. So this is essentially what most active investors were doing during this period. And of course, it was a very sudden and just dramatic time. One investor we work with a lot, who's based up in Montana, who's a part of our angel group, but also operates a fund, he really summarized it well. And what I talked to him early April, and what he said was, every company right now is either surfing, swimming, or sinking. And what he meant by that was, the companies that might have been sinking in mid to late March, early April, were those, of course, in the hospitality industry, in travel and leisure. Those were in major trouble. They were obviously in the first ripple of the ripple effect of the pandemic. So those that were swimming were ones where they maybe were not in that first ring of the ripple effect, but their sales were obviously slowed. Revenues no doubt be down on the year. They had to make some layoffs, but provided that they're displaying good cash management, they'll survive. They'll be able to get back on the board. And then the companies that it was evident were surfing were suddenly their industries were accelerated as a result of the pandemic. So, telemedicine is a good example. Education technology, where suddenly schools were having to rapidly shift to remote learning. So those were instances where they were actually performing better as a result. So this is what investors did. We took time to kind of classify where companies were, prioritize the ones that needed extra help, and then, we moved on. Now, this is important because as we were trying to help our existing investments, one thing that was really consistent is we were all trying to help folks conserve cash. And I think that was a big lesson that is going to apply to fundraising going forward, even with new investments. We as investors are going to be a lot more conscious about a company's ability towards cash preservation and just overall capital strategy. And I'll talk more about that in a second. So from there, many expected by like early mid-April that capital would just totally dry up. There was such economic uncertainty that no one was going to be writing new checks. And so what happened was actually not that. Investment was still happening. This just shows, this is a graph from Crunchbase, just activity through the end of May 2020. But it showed in terms of dollars deployed that there actually wasn't that much of a reduction from what we'd experienced pre-COVID. Now, pay attention to what it says here. It's looking at everything from pre-seed, seed, through the sort of alphabet of Series A, B, C, and so on, all the way through to private equity. So it's really looking at capital across the board for private companies. And then if you look at through the end of the second quarter, so recent data, that type of activity seemed to continue. So there wasn't really that slowdown that everybody expected. This is from CB Insights and PwC. And this is especially interesting because if you think about the second quarter of 2020, this is really the first full quarter that impacted by COVID. So to see such a light impact on overall deals and dollars deployed was promising. Now, if you look at this, you will see there's a decline on a year-over-year basis. If you look at second quarter 2019, it's about an 18% reduction. But it's not as severe as many people expected, especially from the first quarter. So impact feels minimal on a market basis. So all sounds good, right? You're telling me everything is going to be great, business as usual. Not exactly. So you kind of have to look into the data a little bit further to really answer our question about where people are investing right now. So in spite of relatively light impact to the investment market, many are still expecting a slowdown. One of the reasons that you're seeing just this continuation of investment right now across the US during this pandemic period is there were more VC funds in play leading up to the pandemic than ever before. At the end of 2019, you can see here on the slide, there were 1,328 venture firms in existence, managing about 2,200 active funds. And that was 444 billion in assets under management. Compare that to just 2010, just 9 years earlier. I mean, it's a pretty massive jump. We're talking about about 73% jump in terms of active funds, almost 90% jump in terms of assets under management. So there's a lot of dry powder out there going into this pandemic, and dry powder is kind of a term referring to cash that firms have raised, but not yet deployed. And in fact, that dry powder, those new funds raised, rose for a 7th consecutive year in 2019. So there's a lot of capital in play going into this. And I'll just say, it's the job of a VC fund manager to deploy those funds. If they don't invest, they don't really have a job. So they're not going to just completely stop. So that should be, hopefully a silver lining in this, that there is capital out there. But they will be taking longer to make new investments. And they're going to be investing in a different manner than a year ago. And more on that in a moment. But I'll just add, the other thing that is happening right now is that, unfortunately, for actually everyone, exits are on pace for their lowest annual total in almost a decade. And why that becomes important is that exits drive this market. That's how capital gets recycled. It's how investors are making the returns. It's creating new investors as founders like you on the call are having exits and suddenly coming into enormous wealth. So as those slow, so too may investments. So that is something to just keep in mind. The other thing is this dry powder I'm talking about, that's going to continue to go first towards protecting existing investments. It's one of the reasons why deal counts remained so high thus far this year. Many of those that you're looking at are in the later stages. And seeing how most of us in this session are early stage businesses in pre-seed, seed, and early Series A, we need to really look at that data closely. And so if you do look at just really the seed and angel level, data is showing that those stages are down so far through this point of the year. Overall number of dollars and deals dropped in the second quarter. So you're just going to have to expect more competition for investor dollars. That's just something that we have to swallow as we're going into a raise this year. So here's what's happening. We got slowdown from angels and early VCs. The later stage VCs have capital, but they're changing the way they invest, and they're going to take a longer period of time. So as founders, you need to adjust accordingly. And so the next thing that we really need to think about is, what is this market value right now? What are investors really prioritizing right now as we're putting together our plan to fundraise? And we know that there's going to be competition for dollars. We know that it's likely going to be more difficult to raise a higher round if we learned anything from 2008. So what are we valuing? So one analogy that many investors are thinking about right now is this concept of camels versus unicorns. And about a month into the shelter in place, I think Crunchbase put out an article about this. And the argument was startup companies no longer should be setting this benchmark of becoming a unicorn. They need to be more like a camel. And so um, if you're not familiar, a unicorn is a private company that has a valuation of $1 billion or more. And when that term was coined about 7-8 years ago, there were about 40 of those companies. So it was truly a unique thing. It was like finding a unicorn. Today, there's more than 10 times the number of companies that qualify. And there's a number of great Colorado companies like Guild Education and Abada that are unicorn status. And so that's exciting and all, and those get a lot of good press, and those are all over TechCrunch and stuff. But this notion of extremely rapid growth and really prioritizing growth over, say, making money has had some consequences on the market and really on the culture of a lot of well-known startups. WeWork's a really good example of that. So unicorns have been this sort of benchmark, this echelon that a lot of startups want to hit. On the other side, you've got camels. And so the camels are startups being built to offer real, meaningful innovation and to survive for the long haul without the need for constant infusions of cash. So it's about considering thoughtful, strategic growth versus the highly rapid, huge burn rate type of growth that unicorns have displayed over the last 7-8 years. So it's about being financially cautious, maintaining a couple quarters of reserves, stuff like that. And there's a shift happening in the VC and angel mindset of growth at all costs to reasonable growth with a path to profitability. So it's much less exciting, I know, but it could be the reality that we're facing going forward. And so it's something that as founders, we need to keep this in mind. And so the takeaway here is that you really need to be conscious of your capital strategy. And so you need to be stress testing this with your advisors, with existing investors, certainly with your team, because investors are going to be looking at this more carefully than in the pre-COVID period. And so what we're talking about here is both knowing how much capital you need to raise today and what the use of funds looks like and what that runway is, how much time that's going to effectively give you. But really, what milestones is that going to buy you? How is that going to create value for a next round? And then what does the next round look like? Roughly how much capital do you need to raise? Roughly what milestones do you think that will buy you at that time? And what about the raise after that? And after that, through to an exit when investors can get a liquidity event and get a return. So this is going to become more important in a downturn period than ever before. Again, investors are going to be very conscious of your capital plan. And so you need to have this in mind before you're going and talking to them. The other thing, it's not just how much capital you're raising, but how are you really managing capital as a business? So, we're looking at how you reacted to the pandemic. How did you make adjustments to become more capital efficient? How did you streamline expenses going into a raise? Because that's going to tell us a lot about how you'll use your capital going forward. The other thing that coming to the table with a capital strategy does is it helps investors to do their diligence on whether this round makes sense for them. And it will help you, of course, come off with more credibility as you understand the need for capital preservation. So this has always been important, but now more than ever, this is something that you need to know front to back. And so coming to the table with this in mind is going to be important. The other thing is traction. And again, this is not new. This has always been something investors value. But one clear observation as we're out investing now and talking to other investors around the country is that investors are getting more particular about needing to see demonstrated traction versus just investing in projections and the promise of where a company will land. For instance, those that are showing short-term growth, closing new customers, certainly generating new revenue, but also customer retention. Right now, that's a big traction point that we're looking at. Those companies that are able to show those proof points, they're able to raise from a position of strength. So coming to the table with a demonstrated bit of traction is going to be more important over the coming months than it was, say, 7 months ago. And this obviously helps if it's revenue, but again, doesn't have to just be that. So if it fits your company, it could be traction you've made towards regulatory approval, if you're, say, a medical device, or patents awarded, partnerships formed, LOIs signed. All of these things where you're showing positive proof points, it goes from being a hypothesis to something that's more real, and that's going to become more important going forward. All right. Just a quick check on the chat. Doesn't look like any questions are in, so just remind you, if you do have any as we're going through, please feel free to submit. All right. Third thing here. How are you positioning yourself? And this is important. Amid what's happening right now, certainly it's important to position where your company fits, but really, where are you positioning yourself for the future? And, here's one quick thing I'll say is you need to acknowledge the elephant in the room here. You need to note how your solution is going to play a role in the new normal that the pandemic is causing. One example of what not to do. There was a company I talked to in May, software company developing a product for commercial real estate and commercial office space providers. And nowhere in their pitch did they address how their solution will be impacted or how that market will be forced to adapt to companies very likely utilizing less office space than ever before. So that was a big red flag. Of course, it came out during Q&A. That's where we had some questions. But to not address that was really strange. And it was, of course, the thing at the front of everybody's mind right now. So you have to address where your business fits in this new normal. Not doing so loses credibility, and it just comes off as tone deaf. Now, of course, in commercial real estate, it's really crucial, and there's a couple of categories where it's really obvious. But I think it's important to really clarify how you think you will look in the new normal, even if you're not in one of those obvious categories. So that said, as we mentioned earlier with the analogy of surfing, swimming, and sinking, there are some areas where you can be raising from a position of strength right now. Here's just a few that have seen a big uptick in investment during the COVID period. So obviously in healthcare, there's a lot of investment dollars and interest going into things like telemedicine, teletherapy, diagnostics, rapid testing. There's a lot of categories where healthcare is seeing a lot of interest. But also future of work, as we've all shifted to a virtual environment, remote work solutions, video conferencing solutions like what we're on right now, et cetera. And then education technology, another area where we've invested that we've seen a big uptick in acceleration as there's suddenly this need to have remote learning technology in place. And then other areas like cybersecurity, as higher internet usage and data generation is taking place, there's of course more vulnerability, and many systems have to move online and operate virtually at a incredibly rapid pace. And then logistics and supply chain might be one obvious one. So just some examples, if you're in these categories, this now becomes a big part of your narrative as you're fundraising, where you fit and why this may be putting you in a position where you're surfing as a result of the pandemic. On the other side, there's of course obvious categories where you're unfortunately in a position of weakness going into a fundraise. If you happen to be in, the travel space or leisure or hospitality, I mentioned commercial real estate, unfortunately, this is just something you're going to have to deal with. And so whether you've maybe made an adjustment, you've made a pivot of some kind, and you found an avenue of value in a very difficult market, I mean, you're going to need to address this. It needs to be a major part of your narrative versus just sweeping it under the rug. So maybe you're in one of these categories, maybe you're somewhere in between, but wherever you are, this is something you really need to be thinking about as you're going into a fundraise. How do I frame my raise so that I'm coming off from a position of strength? And you've no doubt heard that the best time to fundraise is when you don't really need the money. And that's very true. And so a strength would be if you're coming to investors and you're showing certainly growth in revenue, growth in users, customers during this period. which in turn, gives you more breathing room as you're likely going into what's going to take a little bit of a longer fundraise period amid the pandemic. So another strength, you have probably a minimum of 6 months, ideally 9 months of cash or more on hand and runway. So you're not in this immediate near term to bring in new money. But you're demonstrating that along the way, you've been able to be really cash conscious, extend your runway, manage productivity, and ideally close some sales, gain some traction with a relevant product during these times. I think the relevancy is something that you need to be thinking about as you're positioning your raise. Another strength in my mind is a pragmatic path to profitability today and just showing those strong business fundamentals. Again, not forcing you to think like a camel, but you need to have camel-like tendencies going forward. And then also showing investors that you have a well-defined exit strategy. That's going to be a position of strength. So they have an understanding of roughly when and how they could get a return on their capital. That is going to help them to justify if your investment makes sense for them and vice versa. Now, on the other side, raising from a position of weakness, it's not just if you're in one of those industries I mentioned. There's other factors that you need to be mindful of. So, if you're in a position where you have 6 months or less of capital, it's not a position of strength. Investors are also understanding that customer churn is happening right now, especially if you're in a, say, B2B company. It's understandable that your customers are cost cutting to keep their businesses afloat. But it obviously doesn't help strengthen your position. So what you're doing right now to mitigate that and, hopefully turn that corner soon. Another weakness would be a plan matching that pure growth model of companies of the year plus ago. So the unicorn model, where you're just planning on rapid growth with really no planned profitability until after a potential exit. Weakness is really not having an exit strategy in place in my mind, so that, given we're making a really extremely risky investment in an increasingly risky market, we don't have a guideline to indicate that the company that we're backing has an intention of providing us a liquidity event. So that's going to come off as a weakness. So there's little things you can be doing to adjust your raise so that you can be coming from a position of strength. So be considering that as you're going into a round. Now, for those of you that might fall in the category of folks that raised capital recently, maybe last fall or early parts of this year, you obviously have great timing. So congrats on that. But you might be concerned about runway. And so I'll just say what we and many investors I know have largely advised is that you consider opening an extension to your last round. So what that means is, say you recently raised $500,000 round on a $4 million valuation. What you would do is then go back to your board and to your existing investors, and you get approval to increase that raise from 500 to, say, 750,000 or $1 million, but at that same valuation. So it'd be what's called a flat round. You may have argument for increasing your valuation at this point, and certainly encourage you to go out and try that. But if you want to just bring in some capital quickly, even possibly from your existing investors, it may not be a bad idea to explore this flat round. And we've done this with a number of our portfolio companies. So in general, what you want to be thinking about is trying to optimize right now for runway versus historically what's been thought of as optimizing for valuation. And I'll talk about that more in a second. I'll just say investors in general, everyone I'm talking to across the board is expecting that everything will be slowed. Sales, adoption, testing, regulatory approvals, acquisitions. So there's good reason to aim to extend recent rounds if you can, to concentrate on cash preservation if you can, say, bootstrap a little bit longer to delay our fundraise, or to just position yourself from a strong place so that you can bring in some new capital, because we are expecting things will be slow. All right. I had a question come through. So best ways to pitch, tips for decks What do you want to? Oh, that might have been a Morgan question. I'll address some of that at the end, especially
That
as
was a
we
question, Gabe. Sorry, just seeing
no, no.
if anybody has any questions, just drop them into chat, and we'll definitely address them.
Cool. You were seeding questions. You're doing great. Appreciate you. All right. So let's talk about the next thing, and then we can get to some of these questions here in a minute. So next thing here is being really aware that valuations are going to be impacted. When we hopped into our time machine back to 2008, and we looked at the outcome of the last recession, one of the key impacts was to the early stage was in valuations. They decreased as capital became more competitive. And while there's active capital out there, as we talked about, especially for those of you in the seed and Series A stages, valuations are going to be a filter for the investors that you're catering to. And what we're really being mindful of is inflated valuations that are just out of scope with other companies that might be at your stage in your industry. I mean, even in your same geography, these things matter. And so those that are, falling in this category of really out of scope valuations, they're going to struggle to raise going forward. So, why this becomes important. You need to understand what's out of scope and what's on par because you're going into a comparative market when you're fundraising. So just a quick example here to clarify this. So let's imagine we're all at the grocery store. And if we're all together, let's imagine this is a pre-COVID grocery store. So we can all be in the same lane together, same aisle together. So we're walking down the bread aisle. And, when you walk down the bread aisle, it's an interesting experience because pretty much every product looks sort of the same. Different packaging, different value propositions of multi-grain, seeds, etc. But price becomes a really important differentiation between these products that all look very similar. So for investors, when we are looking at different investment opportunities, it's a lot like being in the grocery store and walking down the bread aisle. We're seeing a lot of things at once. Some of them might look very similar and offer similar value propositions to us as investors. So we often do use valuation or price as a way to differentiate. And so you need to be understanding that as a founder, that this is a comparative market. We are rarely looking only at one loaf of bread at a time. It's very typical that we're looking at 10, maybe 100 loaves. So how you compare to those other loaves is important, and price is really, really important in turn. So one way to understand that, since you can't just go to the grocery store and see where a bunch of companies are valued, is to do a bunch of research and look at comparables in your industry. So these are companies that are operating in similar lanes or maybe an ancillary lane to you, and try to find some information about where they've raised. There's a lot of sources out there like PitchBook and CB Insights that you can gather a bunch of private market data to find where companies are raising, how much, and at what valuation. Then from there, what you want to do is, develop a baseline, get an understanding of what a typical valuation is for a company at your stage. So this is from some data from PitchBook, showing that at the end of 2019, the median seed stage valuation for startups across the US was 6.5 million. And that was up from 3.5 million just 3 years earlier. So 6.5 was high. And a lot of investors pre-pandemic felt like, that was getting to a place of a bubble and was likely to get corrected anyway. It just so happened that, this pandemic was the event that made that pop. So for Colorado early stage investors, as many of you are looking to raise maybe locally, we typically see about a 25% reduction from what we see at a national average. So, the national numbers are often driven by large figures coming out of, the Bay Area, Silicon Valley, New York, and Boston, where there's a lot of dollars deployed. So they're a little bit less valuation sensitive. Whereas the inter part of the country, the Midwest, the Rockies, where we are, typically about a 25% discount to those valuations we see on the coasts. So being mindful of that, that would put Colorado at the end of 2019 at about a 4.875 million valuation as the median. So that gives you something of a baseline. But keep in mind that was pre-COVID. So what many are estimating will happen as we look at the data at the end of the year is that valuations might get corrected by as much as 40%, which is pretty significant. The point here is that in a downturn environment, capital is tighter, and therefore it's going to become a more investor-friendly climate. So if you're expecting that you're going to get a $10 million valuation this year when you're pre-revenue and maybe pre-launch of your product, all because another company in your industry got that valuation in Silicon Valley a year ago, you're going to be met with some blank stares when you're pitching via Zoom. And that's the worst time to get a blank stare because you can't really read a room other than their face. So don't expect that. So you need to come into a fundraise ready to accept a lower valuation than what you might be expecting. And unfortunately, therefore, give up more equity than you would a year ago. And it's an unfortunate reality, but it's something that is going to be what we're dealing with going forward. Now, a quick example, we're closing an investment right now in a company that's based across the country. Our angel group is leading the round with about a $550,000 investment. And the round has been oversubscribed. So there's more interest than the company even wants to take. So they're started by raising about $1 million, and they're up to $1.75 million on the round. And they have probably another 500 to 750,000 of interest to go above that. Now, that's a successful deal and really interesting one, given that most of the investors have never met the founder face to face. They've only engaged via platforms like this. Now, there's a number of reasons why there was such high interest, but I'll just say one of the factors that allowed this deal to really progress and get so much interest was the founder's willingness to not waste a ton of time in negotiating the deal terms. The deal started at a $6 million valuation with a $1 million target raise, and investors felt like that was too high. The founder was really receptive to that investor feedback, knowing that we are looking at a ton of deals, across the country. And so it ultimately landed at just under 5 million. And it fit the projected exit strategy of the company to have a valuation there, more so than it did at $6 million. So that ended up being a better fit, and it was more alignment between investors and founders. And so now that allowed the company to not spend a ton of time worrying about the dilution difference. And they were able to raise more capital, have more interest, be more selective about the investors they could bring in, and now they can get to work. So the point here is you don't want to be spending all your time fundraising, and you definitely don't want to be spending all your time worried about the valuation. Flexibility is going to be really key when it comes to raising this year. That said, you need to be wary of sharks. And what I mean is really sharky investors. They're going to be out there seeking opportunities right now to take 50% equity or more of your company because they know that, suddenly they're in a very investor-friendly environment. So you need to try to avoid those kinds of folks as much as possible. And if you can, be a little more selective. So don't just be taking first money that comes to you. And I know it's a really hard thing to have to potentially turn down, but you need to be doing some diligence on the investors that are offering you capital. General rule of thumb here is that you want to be thinking about selling about 20% equity with each funding round. And we kind of have a hard rule where we don't take more than 30% equity in any given round. Part of that reason is we know companies are going to be raising multiple rounds thereafter. We want you all as founders to remain incentivized because we're all in this together. And if we're taking 50, 60, 75% equity in your company, that doesn't make a ton of sense. And that's why Shark Tank is a very bad education for how fundraising works, because that's what they do. It's not really what happens in the real world. Now, where this comes into play in 2020 is that where maybe a year ago, under 20% equity that you were selling in your business happened all the time, I may now expect that 20 to 25% is going to be the norm. So you're going to have to expect a little bit more dilution. In addition, there's other key deal terms that some investors will look to get a more advantageous position this year and next, given the low flow of capital. So I'm talking about things like liquidation preferences, Anything higher than 1x is really outside of the norm. So you need to be cautious of that. But I have already seen that come into play with a couple of deals. Anti-dilution provisions, which is something that you trigger if you raise around today at $1 at dollar per share, and then you raise around next year at say 50 cents a share, you would trigger anti-dilution. And depending on the type of anti-dilution that you have set up in your term sheet, it can be really disadvantageous to the company. So you need to look out for things like full ratchet anti-dilution. I'm not going to get into too much detail there, but just so you know, look out for the Sharky Investors and try to lean on advisors and folks in your network when you're getting capital coming your way to help with your diligence. All right, and then just to wrap up here, because I want to kind of end this on a positive, I don't want all hope to be lost. We talked about how capital is out there, but it's changing, especially for angel and seed. It's declining a bit, and how you're suddenly going to have to, think about cash preservation and try to find a way to raise from a position of strength. All of that said, this is a ripe time for innovation, and really savvy investors understand that. So hope is not lost just because fundraising is going to get a little bit more difficult. So if you came here thinking that capital is not out there and concerned that there's no hope, hopefully that's not your takeaway from today. The Kaufman Foundation put out this great quote, which we've kind of been living by during this, which is just keeping in mind that while we don't know how this downturn will play out, we do believe in one thing: some of the most iconic companies of the next decade will undoubtedly be launched in this pressure cooker of change, and that this is a unique and pressing opportunity for founders alongside equally intrepid investors to partner in building the economy of the future. And that's just so true. And I think that's the mindset of really savvy investors right now, and something you all need to be keeping in mind. When you look at downturns of the past, it's created some really amazing companies that have changed the world. Airbnb, Uber, Slack, WhatsApp. I mean, all of these came during periods like this. So keep that in mind, that you could be joining these ranks. The other thing is that savvy investors understand that this is a good time to invest, because they can, of course, get some better deals. As we talked about, valuations will be going down a bit. But there's also suddenly, and unfortunately, an amazing talent pool out there to tap. And changes like what we're experiencing now in the economy create opportunities for innovation that weren't there a year ago. And so, we are keeping an eye on companies that can operate lean and stay lean, do more with less. So, if you model yourself as one of those companies, you can still be in a good position. And, lastly here, for Colorado folks, just remind you, there's a lot of investors that are active out there right now. And this is not all of them. This is just some of the local angels, early funds, and later stage VCs that are operating right now. So, be happy that you happen to be operating in a state like Colorado, where there's a lot of supportive investors out there. I'll also just add, there's great non-dilutive sources. We haven't really talked about that today, but just to plug a session I think is happening later today with Katie Wasslager from the Colorado Office of Economic Development and International Trade. They have an amazing program that we've been working with them on for a number of years, called the OEDIT Advantage. I'll tell you a little bit more about that. So there's a lot out there. So just in summary, and then we'll have some time for Q&A. Just know that capital's still out there, but it's changing. And so you need to change your mindset rather than matching yourself to the unicorns of yesteryear. But go into your raise with a capital plan. Know that we're going to be asking for it. Make sure to prioritize and highlight your traction. And don't sweep the pandemic under the rug, because nobody is going to forget about that when you're fundraising. And then last couple of things: be conscious of your valuation. Don't spend too much time worrying about that. But as always, pre-COVID and post, be transparent, be honest, find investors that are aligned with you, and you'll be okay. That's all I had. I think for now, I'll just leave up some info. If you want to reach out, go ahead. And looks like we had a couple questions on the chat.
Yeah, thank you, Dave. That was a great presentation. So yeah, if anybody has more questions, especially more particular stuff or things that you weren't covered, please do drop them in the comments and we'll get them answered. But it looks like Angela Wilson on YouTube had asked, what highlights do smaller investors look for? And maybe even to contrast this with what bigger ones would be tend to look for.
Yeah, thanks, Angela. That's a good question. And smaller, I'm assuming, meaning like angel investors and maybe smaller early VCs. Even though we're coming in earlier, and typically, for RVC, we're engaging when a company's raising a first $500,000 round to maybe up to $2 million. So even though that might be like a seed round, we still are looking for some demonstrated traction. And so again, it doesn't have to just be revenue, but we need to see a number of proof points before we're really ready. So we don't have like a specific revenue criteria the way that some later stage investors do. So there's a number of VCs that will only engage with you when you're at, say, at least $1 million revenue run rate. We don't really have that as early investors. So we do need to look at a couple different proof points to just validate that this is something for us. And then I think the other highlight has to do with strategy. Since we often are investing mainly in the team at the point we're coming in with some other, proof points alongside that, we need to see that the team are strategic thinkers, that they have a plan and a strategy in place for how they'll go to market, for how they're going to raise capital, through how they're going to return that. So those are things that we look for as the smaller investors.
Awesome. I think I did have a question, and I did see this, but then I thought about it more specifically. Oh, Bat Phone's back, my favorite username. If you want to get involved in investing in startups, where do you start, Dave?
Great question, Bat Phone. And especially somebody like you, Bruce Wayne, who's got a nice net worth, you can start today. The answer is actually most investors, most angel investors, start by joining a group. And this isn't a pitch to get you to join RVC. It's where the numbers are, because when you're first starting out, it's a lot of work. You have to go out and seed deals, seed opportunities, conduct your diligence, and often you're writing checks that may not be huge, so it's harder to get some good deals. Whereas with a group, you join, you learn from one another, you can kind of follow other people's leads, and then your check that you write has more power to it as you're part of a larger group. So you often have a better negotiating position. So many people get started through angel groups like us. And then, we're looking at about 1,500 deals a year, and then we can, allow the individuals in the group to decide which of those they really want to move forward with. So that'd be my recommendation is, you check out your local angel group, attend a meeting, attend some classes and workshops like what we put on, and then just kind of get your bearings before you go out and you write a check once you're comfortable.
Nice. So in this virtual environment, obviously, you had mentioned a lot of people are pitching over Zoom or other kind of virtual environments. Do you have any simple, maybe like 3 do's and don'ts of those virtual pitching? Mostly because it's going to stay. Like at the end of the day, we're not going back to in-person stuff anytime soon. So are there any do's and don'ts that you have seen or that you prefer to recommend?
Yeah, absolutely. And I think you're totally right. We've all learned that not only is this safer, but it's more efficient. And so I think this is going to continue for the majority in the future. So a couple tips that I've observed is, and I didn't do this today, so I'm not eating my own dog food here, but I've probably seen like 100 pitches during this period, maybe more. And I've noticed the ones that are really effective are the ones where they consider the virtual environment like the audience in a real auditorium. So they're standing up, they're actually projecting to the audience rather than just kind of like hunkering down and putting their nose in the camera. So think about that. Maybe you stand up, you actually kind of create more of a stage presence for yourself. And while it's really difficult, I recommend turning off your video. So if you're in Zoom, you can hide your self view, because what I really observe is you just kind of see people looking at themselves the whole time, and it really does throw you off. But other than that, I think it's really effective. So you still have to practice your pitch like crazy, but it's something we're going to continue seeing going forward.
Nice. Well, awesome, Dave. Well, thank you very much. I have to do my little LSW 20 job in case you're hanging around here. We have great swag this year. This is what we're calling our standard t-shirt. We also have just a more minimalist pocket tee. So anybody who's watching can go to the longmontstartupweek.co site and hit up our shop. All of our net proceeds are going to support Innovate Longmont and E4All Longmont, which are two of our entrepreneurial orgs in our community. So your purchase or donation, however you want to think of it, is going basically directly to those organizations. And you also get cool swag and some sticker sheets from our friends at Sticker Giant. So, I mean, it's a great year and a very unique branding. So make sure to pick yours up this week sometime. And Dave, thank you again so much for joining us in LSW 20. This was a very fruitful session. And even I learned a lot, especially about raising money in a recession.
Good. Well, thank you, Morgan. Appreciate all the work you're doing, and good luck with the rest of the week.
Awesome. Thank you all.